When you think about the U.S. federal income tax regime, if you're subject to it, you're taxable on your worldwide income, wherever it's been derived from. But the state tax regime is more of a nexus analysis. Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time. Welcome everyone to Alt Investing Made Easy. Today we're going to talk about a topic that will be interesting to investors and to syndicators in who participate in projects related to commercial real estate. Today we're going to talk about what things to consider and issues to consider when deciding on a manager.
Yeah, thanks, Sarah. That's really an important consideration. When we say manager, we say that specifically because that's the management entity for a limited liability company, much like a board of directors is the management function for a corporation. So it's a distinction that we make, and we'll bring this up a little bit later on, but a lot of times in commercial real estate, you'll have the asset that'll be managed by a third-party property manager, but this is more, I guess you would call it the asset manager. And it's a important discussion because it comes up every time with people that are a little new to this business to think about whether they want to serve as individual members of the so-called board of directors. They can serve as managers individually, or they can form an entity, another LLC, to serve as the management entity. And that's what we always recommend for people, but we can flesh that out here in our discussion.
So this is going to be really informative, I think, because we do get lots of questions about this, and there are reasons for questions because there's actually some small details to consider, especially if you're planning on doing multiple projects going forward. You're not just doing the one project. So for this, again, I'm going to take the role of a well-informed client who's come to Roland for his expert advice to discuss, and we're going to discuss considerations when deciding how to structure or form the manager for a commercial real estate project. And a couple other details. We'll just say that I know I may want to use an entity or be a manager in multiple projects in my individual capacity. Also, that's a possibility. I plan to have projects in different states, which brings some other issues up. And then I will be the manager together with my spouse. This could also be with another business partner who's also the manager. But there are two of us. And in this case specifically, we'll talk about the issues that come up when spouses are actually acting as the manager of a project, a commercial real estate project.
Okay, well, that all makes sense.
So, Roland, as usual, thank you for all your usual fantastic support in structuring our projects and helping us with all the necessary plans, structuring, and documentation. So you had mentioned that one point we need to decide on is who to identify as the issuer, as the manager of our issuer company. We're going to call the company that's raising money the issuer company, right, or the issuer LLC. And we need to decide who will be the manager. So we understand we can serve as the manager, myself and my spouse, in our individual capacities, or maybe we want to use an LLC that we own and manage together. But in any case, it's important because we have to identify who will be the manager to finalize the deal. Could you talk us through some of the issues and considerations to help us decide the way forward?
Yeah, for sure. And I think, at the outset, I mentioned it already, but we almost always recommend that you form a separate entity to serve as a manager. You for sure can serve individually as a manager of an LLC. There's no additional liability protection necessarily by forming a separate entity to serve as the manager, and then you're a manager of the management entity. But there's just a couple practical implications and benefits for forming a separate management entity. First, you can sort of not, I don't want to say hide the ball, but you don't have to disclose as many of the profit sharing provisions between all the managers individually. If they hold the carried interest individually, then that's going to be something that the investors will know about, and not that you're necessarily wanting to hide that from them, but they might ask, "Hey, Sarah, why are you getting, 2/3 of the carried interest, and your spouse or your other management team members are only getting 1/3?" It's just another question that you might have to answer. If you have the management entity, you can address succession planning there. If something happens to you individually, then you can address, who steps in for you. You can do that at the issuer level as well, but it's something that you want to take care of for all the deals that you're working on. So it's easiest, it's most efficient to have this singular management entity that's going to manage all of your deals for you. And I think the last practical advantage that I would bring up is you have to name it something. The issuer entity will maybe have their own identities and maybe be related to the specific assets that you're investing in, but the management entity can really be the branded entity, so that you're creating this brand name, so that I know, Sarah for Investments, that's a good deal. Sarah for Investments is the management entity, so I know that any Sarah for Investment deal is going to be something that I feel good about.
All of that makes a lot of sense, especially because also maybe things change over time. When you're the manager, you have a change in how you split the carry. So then all of that's taken care of at the entity level. It doesn't have to be redisclosed, really. If you disclosed it the first time, then you probably do need to redisclose it if things change, I would imagine. So just maybe I'm a little confused, but we also are going to be using a property manager on this deal. Is this the same party? This the same company that does that?
It can be. And what I recommend to clients typically is that they provide this disclosure, that we will engage a property manager to serve as the manager for the day-to-day operations of the real estate asset. And this is standard. The property manager typically gets paid by a percentage of the gross revenue derived from the property. 5 to 7% isn't unusual. And then, in addition to that disclosure, we're saying we're going to hire a property manager. Right after that, we say we retain discretion to hire ourselves as the property manager. Okay. So there must be a property manager. Somebody must manage the day-to-day operations of the real estate asset. And it's either going to be a third party that does that professionally, and you pay them, and whatever you pay them, that percentage of gross revenues, it's an expense of the issuer. Or you say, we can hire ourselves and we're going to pay ourselves that amount. It's a related party transaction, so it's important to disclose that. It's also important to disclose that you're not going to be paying yourself either more or less than what would be commercially available from an unrelated third party. You want to make it fair and make sure that you disclose, because again, investors get the most mad when they feel like the issuer has hidden the ball from them, and an investor finds out later on, I didn't know that you were going to be the property manager on this. Well, no, we told you about it. We disclosed that we were either going to hire a third party or we were going to hire ourselves. And then we went on to say that initially we hire ourselves for that.
So let's assume that we're going to hire ourselves. Is it a good idea to use the same LLC that we use as the manager as also the property manager, or is it a good idea to consider having another LLC for that?
Yeah, I mean, I think because of the potential for liability, the lawyer answer will always be form a separate LLC, but all of a sudden you get all these LLCs that you're having to form, and it's just kind of thinking about what the function of each of these entities would be. The asset manager LLC is really serving a different function from the property manager. And then you could think, you form the separate property management entity, and theoretically that's its own business, and you could go out and maybe attract other clients for that. So it's kind of a toss up, but I think the lawyer answer, like I said, and the practical answer too is form a separate entity for the asset manager. And then for the property manager. But if you don't want to do that, I for sure understand, and you just have to understand the potential issues that could come up.
That makes sense. So all of this is really informative, and I think we'll proceed with forming an LLC as the manager LLC, and separately we would also proceed with forming an LLC for the property management LLC for liability reasons, like you say. But today we're talking about the manager LLC. So are there any other issues that we should consider?
Well, yeah, and this is something that I mentioned before, is that typically the asset manager is going to hold the carried interest. So like on almost all our deals, very generally, you could say the Class A unit holders are the investors. We always make the investors a Class A because people want to feel like they're important. Class A and Class B. Class B is typically the class of units that have the carried interest, and those are sold to the manager, or sometimes we're talking about forming different entities. The manager might form a separate entity to hold the Class B units. So but that is something that is important. And again, as I mentioned before, if you just disclose that the asset manager entity holds all the Class B units, you don't necessarily have to describe how Sarah and all our other partners are going to split up the profits. It's just, the voting Class B shares units are held by the asset manager. And then you disclose the individuals who are heading up the asset manager. You always have to disclose what natural persons are involved in the deal, but you don't necessarily have to disclose all of the economic relationships between the asset manager entity and the principals, the individual natural persons who are involved.
Okay, so what I understand is that we can always hold those Class B interests in our own name, say myself and my spouse or my other partners. But then that's also disclosed, and then changing it involves work to change, who owns what percentage. Or we can use the LLC, the manager LLC that we set up, whether it's just for this project or for multiple projects, or we can form another LLC that's just for holding that carried interest separate from the manager LLC, because actually they have two different sources of revenue and maybe two different sets of issues that are going on in terms of how that's all shared and liabilities related to that. So that's really interesting. And it's an important point to consider that that actually you can have the manager LLC be separate and not have to be the Class B member or interest holder. That you can actually decide to separate all of that. And of course, deal with it being disclosed. And that's why we have to decide all of this now, right? So that it's put into the disclosure before we open up the offering to start taking investor funds. So we'll think about this point further, but in terms of other issues, what should I consider?
Well, the choice of entity is a challenging topic generally. And so, we're talking mostly here about LLCs again for simplicity's sake. And I think generally we're always going to be talking about an LLC unless there's a specific reason. But the choice of entity also implicates where do you organize the LLC. And this regards really a couple of related issues. First, you should be thinking about where the assets are located for commercial real estate. Generally what we say for the issuer entity is that form the entity in the same state where the asset is located. Either that, or you form a separate, an entity out of state, and you have to think about whether you need to qualify that out of state entity as being eligible to do business in the state where the property is. So a lot of times it just simplifies administration just to form the issuer entity in the same state. But you don't have that Same issue necessarily with a management company, because the management company might be managing assets in different states. And so there you may think, well, we can form it in one of these other favorable jurisdictions we always hear about, like Wyoming or Delaware. And then, that entity, that Wyoming entity, that Wyoming LLC, that Delaware LLC will serve as the asset manager for assets that are located in different states. The same issue comes up, though, with the management entity, that you have to consider the state laws where the properties are, and to determine if the fact of engaging in the management of that property requires the out-of-state entity to qualify to do business in that state. And as soon as you qualify a foreign entity to do business in a state, and presumably you're doing that because it's a requirement of the law. As soon as you qualify a foreign business to do business in a state, you become subject to that state's taxing regime, and you have a filing obligation with respect to that entity. So really, this is a lot of this has to do with state tax laws.
Okay. It sounds like something that needs to be planned out in terms of all of my other assets and where I have to do filings anyway. There's some efficiencies to consider there, maybe if I already have interests in other states. And also, but then maybe also, since we expect to do business, to have projects in different states anyway, then it's really just a matter of deciding, where things are easiest to manage the LLC. And we're going to have this foreign registration issue and potential taxation issue in those other states regardless, just by nature of having projects there. So I find that so interesting, because even in our one country, we have to really consider which state and which tax to consider in terms of how to be efficient about all that, and based on the basic operations of what we're trying to do.
Yeah, and one other thing should be said about the state tax regime is that when you think about the U.S. federal income tax regime, if you're subject to it, you're taxable on your worldwide income, wherever it's been derived from. But the state tax regime is more of a nexus analysis. So what some people do is they'll form the Wyoming LLC to manage, let's say, a Texas entity, and I don't know the specific rule about this. Actually, I would have to check, but would having the Wyoming entity managing a Texas LLC with a Texas real estate, would that require out-of-state registration for the Wyoming entity in Texas? And like I said before, if it does, then the Wyoming entity would have an obligation to file a franchise tax return with the Texas controller. But then it only has to report its Texas connected income. It's that nexus analysis. And I think it would be hard for the manager to say that, well, this isn't Texas connected income, and there's limited entity liability under Texas's franchise tax law, so it's not a real practical consideration. But the manager could say, hey, I'm a Wyoming entity, and all the income that I derive is Wyoming based, so I don't have a Texas filing obligation, or if I do, then I'm just going to say that all my Texas connected income is zero. And that may not necessarily be the right answer, but that is how some people will game this. And we for sure can't counsel anybody to take illegal activities, but we, if they want to report it like that, we're not the police, we're enablers. We want to help you do whatever it is that you want to do as our client.
Right. But I think the example of Wyoming is, can you actually make any recommendations about which states are used most often for these manager LLCs? You say Wyoming, are there any others?
Well, yeah, Wyoming and Delaware, I think, have been popular in the past. Nevada. I really like Wyoming, honestly, and for a couple of reasons. It's a favorable tax regime. It's really easy to set entities up there. It's cheaper. You form them. You can do it online. You get the articles of incorporation or organization, I think is what they're called in Wyoming. You get them back immediately. Delaware, there's a lot more hoops to jump through. And the other thing that's really important, no matter what, is if you form an out-of-state entity, whether it's Wyoming or Delaware, and you don't have offices in that state, or even if you do, you must appoint a registered agent, and the registered agent is the person that receives correspondence from officials, from the taxing authorities or whatever. But importantly, if you ever get sued, the person will deliver the court papers to the registered agent. So if you don't have an office in the state, if you don't have an office in Wyoming, you have to hire a third party. We have a deal with Registered Agent Solutions Inc. For it's basically $100 a year per entity per state. So it's not a huge charge, but it's an additional thing that you have to arrange for. And but as always, if you do happen to have an office in Wyoming, you can serve as your own registered agent as well. So it's not not a absolute requirement that you hire that third party.
No, but it still adds to the paperwork. You have an address change and you've got like 3 more things you need to do. And, so that actually raises a question, Roland, like what are some other issues? But one question I have is, okay, this is starting to sound a little bit complicated. Maybe I'm starting to feel a little stressed. How can I simplify what I need to do here? Because I have all these plans of doing other projects. And right now I don't have anything outside of the state where I'm resident. So what's the simplest way forward that would make my life easier? Because I'm a new syndicator and I need to focus on making this project successful and not be stressed out or worried about the entities that I have to keep up with and the paperwork on that side.
Yeah, so frequently, you're subject to the state tax regime in any event because you live there. And so it's going to be hard. You could form the Wyoming entity, but you still, probably have to qualify it to do business. So, a really good rule of thumb is just form all these entities in the same state where the property is,
Okay.
and it's easy for us because we practice in Texas and a lot of the deals that we do are located here. And so we can and we have a pretty favorable state tax regime as well. The first $1 million of an LLC's income is exempt. So, it's easier for us to just say, well, form a Texas entity to own the property and sell the securities, and form a Texas entity to serve as the management entity. But so that really is the simplest, but it varies from state to state. We have a really strong client in Tennessee, and they've got a different regime there, and there's actually a planning opportunity maybe there to use general partnerships. So that was something that was historical in Texas. It used to be that you would always form a limited partnership because it was completely exempt from the franchise tax regime. So it really just varies state by state. But, again, going for simplicity, just if you live in New Jersey, you're going to form a New Jersey entity, and for the asset manager and a New Jersey entity to own the property. But as with all simplifications or generalizations, the devil's in the details. So let's make sure we talk before you make any decisions.
Definitely. And also, I suppose you can change your way going forward. It's not so difficult to open an LLC and change any of these things. So I would imagine in our example here that, I'll form the LLC and I'll keep it as simple as possible. But in time, it can be changed, right? And you can form a new LLC and make changes to who the manager is. So what do you think, Roland, like breaking out of our role play, what are some other issues that you've seen come up or things that you think people get a little concerned over just because, especially when you're new to structuring private assets or investing in private assets, it all sounds like there's a lot of legal terms and you're setting up entities and all of these things. Is this something, what else do you have to say about it?
Well, so you're setting up this management entity, an asset manager, and you think that you're going to be managing multiple different assets. And so you have the question about ownership and control of the management entity. And it's you said, your spouse, and maybe some other partners. Who controls it? Is Sarah the queen? Does she say, what goes, and if you have to decide whether blue or green paint or Chase or Bank of America, are some of these decisions subject to a vote by the managers? And this can be a difficult thing because sometimes you'll have the people that are the owners and managers of the asset manager entity, they play different roles. Maybe one person is operations, another person is more investor relations. So that can sometimes be more complicated than getting the issuer entity set up, because you've got this management team that has different expectations about the level of control that they have. And, one person thinks that they should be getting, a bigger percentage of the profits. So really just forming that asset management entity, there are issues that are going to have to be addressed no matter what. The control provisions, who decides, makes the decisions on behalf of the issuer. And if it's you and your partners, you either have to address that at the issuer level or in the asset management entity.
Well, it makes sense, though, that to try and work all that out in advance just means that when it's time to get the deal up and rolling, you're not going to be distracted with those kinds of issues, right?
Right. Yeah, you've got it set, and you want as much certainty as possible, and you're trying to establish consistency. And people are going to, a smart investor will ask you, well, what happens, Sarah? God forbid you get hit by a bus. You can say, well, I've got my 3 other team members ready to step in, and we've already got that built into the Sarah 4 Investments LLC management arrangement, the company agreement. So that gives me certainty as an investor that you've thought about, the succession planning, ownership control, and again, forming that entity. Branding is so important, and I really think that investors, their mind attaches to that brand. And if you can create a brand that has value behind it, it's a super valuable thing for all the future deals that you will do.
Right, exactly. And it keeps it consolidated too, because I think we've seen clients who use lots of different LLCs, and sometimes you just kind of wonder how they keep track of all of them. So there's a fine balance to getting the right number of LLCs, but not too many that you've actually just created another task for yourself, which is managing all of those, including the tax issues, et cetera. So, well, thank you for all of this, Roland. It's, I think, super relevant because it's the beginning. You have to sort all this out at the beginning of a deal, or you should. Well, you really have to, because you need to do certain disclosures about everything. And in the end, it's kind of like when you're preparing for any big project, the more that you can do in advance to have things addressed. And that's what we can offer people, is help with kind of thinking forward a little bit and trying to make your life in the future a little more efficient or easy to deal with by addressing some of these hard topics in advance. And the governance of any entity can be a really sensitive topic. Who ultimately gets to make the decisions, and in the event of non-unanimous views on what's going on. So
well, sir, yeah, and I think that seems to be a pretty natural place to stop. And I think we've addressed a topic here that's useful both for investors and for sponsor managers. For investors, thinking about your management team, who's managing your investment, and asking important questions about things like succession planning, control. So we hope that this has given our audience food for thought when they think about these different considerations, particularly when investing in commercial real estate. But if you're investing in private equity or a hedge fund, it's the same deal.
It's the same issues, isn't it? All right, everyone. Thank you for watching. If you liked this episode, please like and subscribe to our channel.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.
When you think about the U.S. federal income tax regime, if you're subject to it, you're taxable on your worldwide income, wherever it's been derived from. But the state tax regime is more of a nexus analysis.